Hello, everyone. My name is John Harvey, and I am the Secretary for the CFA Society Ottawa. It is my pleasure to welcome you all today to our webinar titled Modern Technical Adaptations for Today's Markets. I would like to encourage everyone to use the chat function or the Q&A function at the bottom of your screen to ask questions at any time, and I will moderate the question answer period at the end of the presentation. I'm delighted to introduce our speaker today. His name is Ray Rondeau, and he is a Senior Technical Analyst for the American Association of Individual Investors. He is a contributing editor to their journal, and he is the president of Q Primes, a quantitative professional research and investor education service. Additionally, Ray's writings have been featured in Forbes, Yahoo Finance, Kiplinger, and on NASDAQ.com, and many other sources online. This is our first webinar featuring a specialist in technical analysis, so I'm personally quite excited to expand my knowledge of the use and application of technical indicators. With that, I'll hand over the presentation to Ray, and we'll get started.
All right, thank you, John. As always, we start with a quote. There is nothing permanent except change. And I believe and hope to show you that this is never more true than in today's market. And this is really the primary theme for today's presentation. I want to thank you and welcome you to the presentation, Modern Technical Applications for Today's Markets. We can change the name if we want. And before I start, I do want to thank Ian, Daniel, John, and Julie for coordinating this event. They all do a great job. And also really kudos to the entire CFA organization. Obviously, I'm somewhat different in that I'm a technician. Still an honor to be here, and it's a sincere thank you. Also, the original plan was for me to be up in Ottawa, but unfortunately that didn't work out. But as you can tell from my last name, I have quite a few ties up there, so maybe we can do it in the future. In contradiction to standard protocol, I'd like to start by telling you what this lecture is not about. And it's definitely not about me telling anyone that their investment approach is incorrect or suggesting that anybody needs to radically change their approaches. My way is certainly not the only way. It's only one way. And although I'm a technician for 2 decades plus now, I eventually turned to hedge fund strategies, which is somewhat common because my education's in engineering and mathematics. But I actually spent well over a decade as a trader. And I still teach the master classes at trading expos on this. So I probably have somewhat of a different perspective and approach than you. But I'm confident that each of you will be able to take something from my research and experience today and then contour it into your own investment style. And hopefully it'll help you manage risk or possibly even increase returns. Now, as my bio showed, I'm a technical analyst with the American Association of Individual Investors, and we're a nonprofit organization, but we specialize in non-biased education, information, and research. But the good news is that my research isn't going to be biased. It's not agenda-driven. So if that's not what the presentation is about, let's get to what the presentation is about. And the presentation's focus is on the reality that our markets are changing. And we're going to look at a number of modern or adaptive technical-based approaches and their reasoning. And we're going to see that these differ quite a bit from what we were originally taught in the traditional conventional senses when technical theory started to come about. And we're going to approach this from several different ways, some from logic, some through examples, and some through some quantitative research. And because this is such a short presentation, we're only really going to look at 2 areas, charting and technical indicators. And then at the end, if we want, we can look at some analysis on some major investment markets, or we can do a Q&A or both, or we can do neither. It'll be up to you. Technical developments, a chart reading evolution. This is where we're going to start. Before we dive in, though, I do have to say that I respect your expertise in that mine's different, but what I'm going to be covering here is not in conflict with fundamental-based or classic portfolio management teachings. I use them myself. I'm in total agreement with you that fundamentals in a company's future prospects are and always will be the driving forces for long-term price movements, and that macro-related factors will decide commodity, interest rates, bond yields, sector and industry performances. We are in total accord here. But what I believe is that one can use technicals and other analysis methods to assist with near-term probable directional calls and for guidance for setting execution prices based on logic and reasoning, with the added benefit of it kind of reduces the emotional influence when investing. So to be clear, fundamental approach for the selections of what to buy, kind of a technical approach, more on when to buy or sell and at what prices. We want to combine the two approaches together. Now, there are many areas of technicals that can offer us considerable value, which you can see some of them here, but because of the time limitations we have, we're only going to look at one aspect of chart reading, and we'll cover indicators in section 2. And the one aspect that we're going to look at today is trends and support and resistance theory. And I chose these because I think most technicians would agree that they're one of the most important, along with relative strength, for locating down execution areas. Another reason I chose these two was that it was relayed to me that you already have a good foundational understanding of these. So we're not going to cover any basics. We're going to kind of jump right into the evolutions and the interpretations of it. And I am going to do the interpretations of it because I think it's important, because that's how we're going to see how it's evolved and how the market's tried to adjust and how we need to readjust our approaches to it. Support resistance interpretations, at least as I know it as originally proposed, was something like this. And it's an analogy. I didn't make this analogy up, but it's used quite frequently. The theory is that when we see these lines, and you can see support and resistance lines right here, that when we see these converging lines forming on a chart, and they can be moving averages or trend lines of support and resistance, that they become focal points. They become areas on the chart where everybody tends to look to or gravitate to for insight. And the analogy is kind of like two sides battling, we'll say in the US Civil War, where these support resistant areas become areas of fortification or targets. Kind of think of them as stone walls. And the resistance that price just happens to overcome now becomes support where it falls back on. And we see this quite often, this step-like up formation with prices rising. Now, obviously in the charts, the battlers are kind of the bulls and bears. The market is where it is. There's always two sides to that. But that's kind of the basis of support and resistance. Now, if this theory is correct, we have to ask ourselves, why is this true? And this is really the first critical point of the presentation. Why is it when we see a PPC, which the Canadian markets have been in for about 2 years, and I'm going to show you that later, but why is it we seems that buyers keep coming in these areas and we see selling keep coming in these areas? And my answer to that is the self-fulfilling prophecy. See, it's the participants' beliefs that give technical studies its subsequent importance. And this becomes more relevant as the number of people following them also increases, like in today's markets. Again, the evolution. We see it on TV and everybody's seemingly an expert. And it's because of this that we start to see these structured purchases and sales happening at these key points. As Einstein stated here, and I use a lot of quotes in my presentation, invention is not the product of logical thought, even though the final product is tied to a logical structure. I agree, there's nothing magical about any past price level, or a 200 or a 50 period moving average as opposed to a 199 or a 49 period moving average. And this is even more obvious with fundamentals and stock analysis. Just because a stock bottomed 5 times, we'll say over the last 2 years at a certain price range, dynamics of the companies, the fundamentals, the markets, they've almost certainly changed. And that so-called magical price has little, if any, direct relationship to that anymore. But because we believe it, so it becomes. And here's the reasoning for the self-fulfilling prophecy as we expand on this. The fact is, a whole lot of traders, investors, and a bunch of programmed computers, meaning a lot of money, are all looking at the same charts. We're all waiting for the exact same triggering signals to determine the likelihood of probable future price action. The if and when, if we should buy or sell. And because of this, it fortifies that self-fulfilling prophecy to the price formations. It gives us an element of predictability for reading probable future price movements, and it helps us set our execution targets, which can be our goal with technical analysis. Now, this is certainly not the only reason that chartists believe that reading a chart can assist us. If you remember the Gettysburg analogy that we just used, we talked about these walls or support becoming resistance or resistance becoming support. And there's other reasons for this, again, logical. If we look at this chart and we'll say that an investor happens to purchase at 47 on support, let me ask you, if support breaks and drops down into this area, what is the most likely place that that person who bought at support is going to try to get out at? Probably where he got in at because he wants to break even. He doesn't want to take the loss. And so because of this, you can see one reasoning why support does become resistance or resistance becomes support. There's an element of logic behind that. We see prices on the chart, but there's meaning, there's emotions involved with these prices. Now, just to reinforce this concept, I pulled this chart last night when I was doing some research, and this is a chart of the S&P 500 over a 3-year period ending in 2018. And you can clearly see how many times resistance held here. And you can also see this stepping up motion in these trends. And this is just a closer view of what I just showed you. You can see the trend line clearly formed. And again, you can see it breaks, it steps back. It breaks, it steps back. It breaks, it steps back. There's one famous TV technician likes to say, to the penny. Now, it's not always to the penny. It's not supposed to be. But prices do move this way for reasons. So now, what was the classic interpretations for support and resistance? Well, for long entries, you would either look for pullbacks to the trend line for some of the reasons that we just talked about, or you would look for a meaningful breakout, a strong signal from the market above established resistance levels. And we're only going to really be focusing on pullbacks to support, but they transfer the same evolutionary meanings that you're going to see no matter which way you would use support and resistance. For long exits, the original interpretations were to liquidate positions at formidable areas of resistance, like this downward sloping trend line every time we bumped here. And certainly we would look to liquidate positions on meaningful broken support levels. We would certainly look to probably get out there. And that's the way it was taught. And to some degree, it still holds. Now, I'm going to run through how a chartist would analyze a chart of gold. It was for an article that I wrote for the AAII Journal many, many years ago. But it kind of shows all of these basic concepts together. And I want to try to drive this home so we can build on this going forward. So a chartist may look at points A and B here. They would extend their support line over. And we'll say they were looking in this area to perhaps get long. Well, the most likely spot they would look to, they want to buy as low as possible, is around here in the 1546 level. We see the buyers come in. It kind of forms this bullish bowl pattern. We have a downward sloping trend line. As soon as it breaks into the void or the field, where is prices most likely to go? Back to point G, where we extend from E and F over, which is now a resistance. Prices start to pull back, 1 touch, 2 touches, we extend off the pivots, the trend line, we have a slight battle at point H, price pulls back at point J. This is the key point. The bulls try to step back in, push prices back up, and we can see they're unsuccessful. And in fact, at point J, the price of gold drops 12% in 2 days. Look at that volume spike right down here at point K. Now, I am no way stating that the large drop in gold prices were because of a line on a chart. Gold was going to do what it was going to do. But what I am proposing to you is that the magnitude of the drop was related to the technical landscape. And this seems logical. Essentially, every technician and every gold newsletter that was being written at that time had isolated this area that if it broke, you may want to get out and look for a better time to get in at lower prices. The technical landscape moved money. Here's a couple more just to drive this point home. This is Amazon. Again, you can see the beautiful sloping trend line, support, 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 bouncing off the downward sloping trend line, the gap over, gaps up to resistance, and then when it breaks through, it's smooth sailing and price takes off. A rhyme and a reason to the price formations. Here's a classic bullish bull where the people trying to accumulate don't want to spook the market. They try to go in slowly, the big gap off, call it a breakaway gap. Again, support, support, and you can see how prices tends to gap and gravitate to these areas and then take off. That one was on Netflix. I'm sure you're already familiar with this, but I just want to make sure we're on the same page here. Our second critical concept. Now, this quote isn't famous because it's mine, but it really does highlight an important point that I find that even some professional investors sometimes misunderstand. Technical patterns and trend lines don't tell us necessarily if a securities trend is going to continue, but they do indicate where and when the trend is most likely to resume its path, if it's going to do so. The stock is going to do what it's going to do. The commodity is going to do what it's going to do over the long term, whether there's a trend line there or not. Enron, Bear Stearns, Lehman Brothers, they were all at major support on the way down, and they're still not worth anything today. So these technical patterns don't tell us if it's going to happen, but they guide us to where it's most likely to happen if it's going to happen. And that's a distinct difference. And one last time, because we're going to build off this chart later. Here's one on Murphy Oil. Same thing. We could see a trend line up, a big gap down, trend line up. Of course, it gaps away. Prices pull back to that level. Resistance, resistance, resistance. Support. The buyers try to step in and support. It's the only area that they feel that they can group together. It breaks down. Of course, price drops from there, usually rapidly. Same formations. We have capitulation right here. You can see the high volume spike and the break. This is called the pennant formation, and prices take off. So that's a little chart primer, okay, on support and resistance. Now let's look at some charting evolution, which is really the focus of this presentation, and why what worked yesterday may no longer work today. And it's logical, at least it seems so. Original guidance for determining if a trend was likely to continue or reverse was to look for support on a pullback. You want to buy at the lowest prices, and you want to invest with the issue's prevailing trend, again, at the lower prices. And investing on pullbacks with the prevailing trend is still sound, but the assessment areas and the entry locations has changed. And I think most professional traders would agree with this. So way back, there seemed to be a teaching to purchase right at the supported trend line. So you would wait, and when prices got there, you would look to execute right here. This is a chart of Berkshire Hathaway, and we'll say resistance is around 83 and support's around 78. So we would look to buy right here. But there was a problem with this, even with the self-fulfilling prophecy, and there's a reason why it didn't, or it certainly doesn't work now. And the reason is, as I showed you in the charts, because of gapping. When technical formations break its support, price often plummets, and there's no chance to get out. No orders are filled in these areas, and you can't get out at your desired price. The markets weren't stupid, and they knew where the stops of the technical exits were and where the supply and demand voids are. Now, the constant gapping that we see from these key obvious technical formations, it's certainly confirming of the validity of the influence of the charting landscape on prices, but it didn't cut your losses. And it's also the reason why you can't get rich simply buying at support and trying to sell at resistance. And this is one of the primary reasons that swing trading has died compared to the number of day traders that still exist, because they just won't take the overnight risk. In swing trading, I don't know if you remember, it was very popular maybe 10, 20 years ago. It's just a short-term trading strategy where trades were focused on like a 2 to 5 day holding period. But people just kept getting burned on the gaps from the obvious technical setups. And here you could see, which is kind of interesting, on annually what happens when it releases dividends. And we all know when a dividend's released, the stock drops approximately the amount of dividend. It has to do this, although some retail investors will insist it doesn't. It has to. And you can see at point A right here, you can see the dividend date. At E, you can see it when it went ex-dividend. You can see the prices, and you can see how price tended to plummet off these areas. And even at point C, another ex-dividend date, in point D, we can see the price dropped, but then it pulled right back, right to the penny, closed the gap just as you were taught, and then price came down. Same thing here. It pulled back up to the penny and then plummeted from there. It shows the trading influence and the technical influence on these gaps. So prices are going to gap, and they can gap anywhere. But the question is, when they do, where is the closest equilibrium point? And again, the market started to evolve. So instead of looking to buy, we'll say, right at the lower point, people started to learn to wait for confirmation from support. And we're going to look at this example, and this is really a trading example. It's not an investment example. But again, it's the same Berkshire Hathaway chart. So if it's going to gap, we might want to buy here so it gaps back to support, as opposed to buying right here. And if it does gap down, we're going to have extreme losses. So we use these level, and I'm just showing you basically the P&L of if you anticipated, or we'll say if you waited for confirmation. And with the anticipation approach on the top, we're buying at lower prices and we get more favorable statistics. And we're going to have less risk. We're only risking $200 with a stop at 76 if we're buying at 78, as compared to $300 if we're buying at 79, waiting for confirmation. And of course, we're also going to have less profit. In this case, we're buying lower. In this case, we're buying higher. And this just kind of shows that you are giving up something by waiting for confirmation. But as investors, or specifically traders, learned, it was better off in the long run, because when prices gap, it gapped to areas where you lost less and you had some element of control. Now, the question becomes, Ray, if I'm going to wait for confirmation, where do I wait? How far do I wait for it to confirm up? And that's a little bit of an art, and it's a little bit of a science, and it comes with a lot of experience. And it's really a couple-hour presentation in itself. But I'm going to give you some basic guidelines on this. One of them is from a technical perspective, and one of them is really from a position management perspective, where you don't have to use technicals at all. On the technical side, one can look for deeper analysis for probable determinations on if the trend is going to hold and where to enter it. I'm just going to give you a full. When we see these price channels like this, if price fails to reach the top part of the channel and starts to turn around, then that's a sign that the trend may be shifting and that support is less likely to hold. So you'd wait for more confirmation. Another clue is look at how much time price spends around these support resistance boundaries. If price is barely coming down and touching it and prices are firing off, heading up, that's a sign that the market can't wait, that the trend is very likely to continue. Relative strength is also another thing. When this is being formed, if prices start rolling over when the rest of the market or the sector or industry is moving upward, that's another sign that it may be less likely to hold, and you may want to wait for more confirmation. A very important one is meandering or aggressive approaches. We want to see prices coming into support and kind of sliding and turning upward, more like we see here. We never want to see prices screaming down, heading right towards the support barrier. If we see that, it's less likely to hold. It's just logical. Another thing we want to look for is conviction, the conviction and the intensity of the moves. And here we have volume on the bottom, and we want to use just traditional volume analysis. We want to see volume expanding. When we see movements with the trend, we want to see volume heading upward. We want to see the intensity and the conviction. And if prices are falling, we want to see them start to fall on lower. This is just a retracement. It's just a natural phenomenon of any upward trend. And all of these things can help us with the assessment if prices are likely to continue and how much of a confirmation we would be looking for if we want to enter. You can always drop down to a lower time frame. So here we have a chart on Dollar Tree, and we can clearly see support over a very long period. Prices come in. But where might you want to enter? Look down at a 60-minute chart, and you're just getting a better view of this. Now look for resistance, and when we see the break over resistance on the lower, then that might be an area that you may want to consider entering. There's another one on Dow Chemical. Again, prices coming in, looking like they're turning. We'll jump down to a lower time frame, look for the trend. This is kind of an inverse head and shoulder pattern or some type of bullish bow. When we see prices jump into the price void, then we would know to go in. So there is a way to get the best of both worlds without using technicals, where we can get the better profit loss ratio of anticipating because we're buying at lower prices, and we can get the better hit ratio of waiting for confirmation, buying at higher prices and having more winners over the majority of scenarios. I know this room has professionals and you're probably already using this, so I'm just going to run through it quickly. But how can we do this? We can do it with options or derivatives. Let's say that we're going to sell at our profit target of 83 at resistance. This could be fundamental or technical based. It doesn't matter. But instead of anticipating and purchasing the stock right at 78, we wait for confirmation and we buy at 79, the green arrow. But then when we buy, we immediately sell the call out of the money, we'll say for $1 at the strike price of our desired profit target of 83. If we sell the call for at least $1, we recapture the difference that you lost with the options premium received for not buying at the lower anticipation price. And then we get the higher hit rate, and we also get the same profit loss rates or better in most cases. And here we can just see a simple P&L on a covered call position, because that's all it is, with the straight stock purchase in blue, and we can see the covered call position in green. So if you're wrong in the direction of the call and price goes down, are you glad that you sold the call? Yeah. You're going to lose $100 less, as we can see. If price stays the same at 79, are you glad that you sold the call? Of course. You've made the premium. You were wrong. It didn't go up and you still made money. If price goes up to $83 in this range, are you glad you sold the call? Yeah, you got the premium of 100 plus the stock appreciation of $400. You made your maximum profit of 500. What are you giving with this strategy? As you can see here, if price goes up above that level, then are you glad you sold the call? Well, no, because now you've capped your profit potential. So there are multiple ways to approach this. Now, although the exact interpretations and methods will certainly vary from technician to technician, confirmation probably is the better way to go. But unfortunately, the market looked to exploit these relationships in another way. So we're going to look to our last reading on the evolution. And this is what I think best investors and certainly the best traders look for. If you remember a few years back, Mad Money's Jim Cramer got in trouble when he went on TV one morning. And he started talking about his hedge fund and how they used to manufacture a short-term selling pressure. They would drive prices below key technical events. They would look to accumulate those shares sitting but likely stop orders, and then they would get them at reduced prices. And then they would drive prices right back up over the key technical levels. And I can still remember him laughing about it, saying, it's a fun game, it's a fun game, it's a fun game. So if the existing order placement hierarchy is as we have suggested, with large numbers of stop orders and people looking out from under key areas of support, then why would prices, if not related to new information, suddenly drop down and then rebound back up? And we refer to them as whipsaws and manipulations. And in this chart, we can see both a bull and a bear trap right here. And when we think about what's happening here from a market participant perspective, when prices drop down and snap back quickly like this, evolved investors will jump on this position if they see this, because they think something's up. Premature shorts who got short in this area immediately have to run to cover. They know they've been duped. And if you were long in this position and you got stopped out, You also know you've been duped and you're angry and you want to get back in. And all three groups generate a tremendous amount of upward buying pressure. Not to mention that we pretty much know that some large entity may know something and they've just kind of showed their hand. So that's a good signal. And last one here, we see where sometimes an issue will break to new highs, very short-lived. They'll suck in the buyers and then immediately gap down and go the other way. And often we see this on big intensity. So whipsaws and manipulations are something, that you may want to consider. For those that don't want to read a chart, and that may be many of you, there is another area of technical analysis, technical indicators. And if you still question if price movement characteristics in chart reading has changed over time, technical indicators can help clarify this, and they can help us do it quantifiably. So first, let's define the problem. Let's take a look at Chaikin money flow formula. And if you study this formula, you may notice something peculiar about it. The formula only accounts for the price action that happens during the day. It takes its measurements from the close to the high and the low prices of the day. And I understand the reasoning why he did this way back. But it doesn't factor in overnight price movements, which is now a large portion of an issue's overall movement, as we saw with gapping in the last section. Price movements that happen after 4 p.m. or on weekends or holidays, they all qualify in the analysis and they all affect our returns. So with Chaikin money flow, we'll say if stock ABC drops from $100 in the close on Monday and it opens at $90 on Tuesday morning, and we'll say it finishes at $90.01. It would count that as a bullish day because the stock finished up a penny from the open, even though the stock lost 9.99% for the day because of the gap. Markets are global. I'm not sure that makes sense anymore. And here's another commonly used indicator that was designed years ago, an OBV, or on balance volume. And this formula shows this indicator adds or subtracts all of the day's volume to its previous day's value. And this is based solely on if the closing price is greater than or less than the previous day's closing price. Well, with this formula, at least we're incorporating overnight price movement, but this formula has other limitations. In this example, let's say the price of stock ABC drops from $10 to $9 in one day on 1 million shares. We subtract it from OBV, it's negative, and that's logical. But then let's say that price rises 10 cents per day on the same number of shares, 1 million shares a day, for 10 consecutive days. Well, price ends up being exactly where we started from at $10, but OBV is going to show a big increase at 9 million shares as a positive reading, which is inaccurate. The bottom line on this, and the point I'm trying to make, is that most of the popular and commonly used indicators were written 30 or 40 years ago for usability and convenience purposes. They just didn't have today's computer power that we have now because the markets have changed since then. So if we don't want to use newer indicators, which I would recommend, or tweak the more common indicators, which is really just the new indicators, then we should at least considering adjusting the interpretations. And to do this, we're going to turn to studies and research. One accurate measurement is worth 1,000 expert opinions, and there's more than 1,000 experts' opinions in the technical analysis area. Of course, now we have Twain's proverb here, which completely obliterates that and shows the other side of this. But it's important to acknowledge this, and I have to cover this, that backtesting can and has many known negatives. There's curve fitting, there's over-optimizations, there's artifacts, there's selective gender-driven choice of variables and assumptions. And I believe that I provided the Ottawa CFA an article on this that I wrote a while back for AI's computer investing. The point here when we see this new information that I'm going to show you here is, just like with all studies, there are assumptions and variables, and these studies also have limitations. So for this section, please don't focus on the actual returns, but focus on the relationships of the statistics to each other and what can be learned from them. Don't focus on the return numbers. So here we go. You can see a video right now of the program that we use, very powerful program. It's TradeStation's Portfolio Maestro. And what we did was we tested on every stock in the S&P 500 that was currently in the S&P 500 when we did the study, which was a few years back. And we looked at it over a 13-year period. We wanted a lot of data, the golden theorem, the truth in large numbers. We wanted something that produced thousands of trades. We started with $100,000 and invested $1,000 on every issue that either meets the purchase criteria or the exit criteria of the indicators. And we tried to do the best we could with this. So the 13 period we chose was from March of 2000 to March of 2013. And why did we select this? Well, we chose it because we wanted time when there was a 0% return. We were trying to eliminate a market index directional bias. We didn't want to skew our results to the upside. The first indicator that we looked at is RSI. Now, RSI is an algorithm developed by Wells Weider, and it compares price movement changes to itself. And I've written extensively on this indicator. This is not relative strength, which compares performance to another entity. RSI compares its own current performance to its own past performance, looking for differences in momentum and shifts. And here's a chart showing price in the top with RSI standard 14 period indicator on the bottom, where it's usually placed. And we went with a classic interpretation. We'd look for long entries when the indicator went below the oversold areas of 20 or 30. And then when it crosses up, that was our buy signal. And you can see them right here. And then we look to sell the issue when the indicator signaled overbought readings in either the 70 or 80 range. Now, technicians, what do you think? Should we sell RSI when it first enters the overbought area? Or should we let that momentum run and wait for a change in momentum to start to occur and wait for a cross of RSI downward and through the overbought level, and that would be our sell signal? And that's how we were kind of taught when this indicator was first developed. And you can tell just by the way I worded the question that the answer, at least in this study, was not what I expected or what we would expect. And I'll leave this chart up for a little bit. But interestingly, on both testing samples from 2080 and 3070, we got surprising results. In that in selling, as soon as RSI entered right here, it produced better results on both the 3070 and 2080 levels. That you shouldn't let momentum run. When you got up that far, it was best at that extreme reading, you're probably best not to be greedy. As expected, more extreme RSI levels of 2080 as opposed to 3070 produced a much better total return and really a much more realistic and preferred decrease in the number of trades. I mean, think about that. That's 500 trades over 13 years. It also has an impressive 79% hit rate, and you gained about almost twice as much as you lost. So the key takeaway here is using RSI was the 2080 level was more productive, and surprisingly selling as soon as you got to the 80 level, if you're going to wait that long, seemed to give you better returns. It was best not to be greedy. Now, to save time, I'm going to show you just the statistics on two other commonly used indicators. But I did want to look at this chart right here. And this is on the S&P 500. And these are the only RSI signals over this 4-year period. And you can see it did a really nice job on pointing these out. So here's stochastics. And the key takeaway here was stochastics 1090 was superior to 2080, which we would expect again. But unlike with RSI, at the 80 level, you were better off waiting for momentum to now turn and cross back down through the overall level. And this was not unexpected. As we know, one of the biggest issues with leading indicators is they tend to give us a lot of false premature signals, especially with stochastics, which is shorter term. These results were reinforcing that the best signals occurred from the most extreme readings, and more importantly, that you were better taking the readings only when they were taken in the direction of the overall trend, not against it. So the translation here is you look for long signals only when prices are moving in a confirmed uptrend, and you would look for the signal to get in that area. And as with all leading indicators or oscillators, you want to ignore counter trend signals, right? You don't want to try to fade the market. Dow theory clearly states the trend is assumed to be intact until the weight of technical evidence indicates otherwise. And one oscillator signal is certainly not enough weight for that. The last indicator that we're going to look at here is moving average convergence divergence, MACD. If modified, it's one of my favorites. And I'm not just saying that because occasionally I write for systems and forecasts. Now, this is an indicator that really points out a key area where I think indicators have failed to evolve over time, at least with retail investors. Let me ask you this. Do markets rise and fall in the same manner in volatility? No. Then why would we use the same algorithm, or at least the same parameters of that algorithm, if we strongly suspect that price movement characteristics are going to be different on the way prices move up and down? It doesn't seem really reasonable the way these indicators were first proposed. So here's the statistics on MACD. And the key takeaways of MACD: when using MACD, the best results occurred when purchasing, first of all, on crosses only in the lower zone under zero, and with an 817.9 setting, and then selling only on crosses in the upper zone over the zero on the 1226.9 setting. So you're using two MACD indicators, and here it is, right, the mix, and you can clearly see the outperformance. What became very clear from this study is if you took signals below the zero line, I mean, your hit rate was under 50%, it was only 40%. So you really only want to buy when MACD is low and sell when MACD is relatively high. So the best execution signals always occur at extreme levels. And I just wanted to point this out. A lot of time you can use support and resistance level on the indicators like we see here with MACD because they often line up. This is my last slide on indicators. In my opinion, the evolution of indicators and the way people use them has really lagged. Indicators have their own strengths and weaknesses. Indicators should be combined. People don't combine them. I'm not sure why. Also, I mean, indicators now can adjust on the fly to the characteristics of each individual. Some indicators will literally talk to you. They will post interpretations in writing. I mean, they can be used for scanning, backtesting statistics. You can optimize capabilities. They can generate and deliver signals to you at any time. Indicators can be used to actually execute the trade for you, if not at the computers. Indicators have a lot of advantages. So we end where we begin. The markets are changing. And it is in this presenter's opinion that those who accept the reality and adjust along with it are much more likely to prosper. And it's my hope that I showed you something today in this mini presentation that's something that you can incorporate into your own approaches, and it will aid you in your own investment journey. So thank you.
Thanks, Ray. That was a wonderful and informative presentation. I've got a question for you, and a couple of have come in through the Q&A box. I'll just start with one. You've covered a lot of benefits of using technical analysis. And what do you think some of the cons of using technical analysis is?
That's a good question. Just so you know, I mean, we can do the Q&A or I can jump to live market analysis. I did 5 segments. It's totally up to you, John. There's a lot of negatives to it too. I mean, this was definitely pro. I just wanted to show the evolution and why it's not, for some people, it's not as effective. But some people just become over-reliant on it. They take it as gospel. They start turning off other aspects of the analysis. And that's just not true unless you're a pure day trader. That's one of the biggest ones. People just become overconfident and over-reliant on it as if it's the holy grail. And that's just not true. Another one also is, I should just throw this out there, is people could become over fascinated with the topic. Truth is, if you learn 5% of the right elements of technical analysis, just 4 or 5 key patterns and understanding the meanings behind them, you're going to gain 90% of the benefit. You don't need to know 500 different patterns.
Yeah, makes sense. One other question we have in here is how important is the size of the candle when interpreting how durable a resistance or support line is? So I guess looking at the last candle for the last support or resistance line, interpreting that to how strong the signal should be.
Well, I mean, it's certainly important, right? And certainly the bigger, the better. And as I tried to show, that meandering or aggressive approach is. And the other element that you want to look at also is the amount of volume behind it, behind that candle. One core element of technical analysis is that more recent price action takes relevance over past price action. So certainly we do want to focus more on the recent price action and the closest candles.
So I guess one part of technical analysis, the more recent a pattern is, the more reliable it is than trying to extrapolate it longer term.
That's actually true. If we don't have to, but if we look at the five live market analysis areas, I go through some of them. Larger patterns take precedence over smaller patterns because you're going to get conflicting signals, and that's where the expertise of the technicians really come in. Which ones are more relevant? Which ones take precedence?
Oh, that makes sense. And one last question that came in is how important is to take the single company chart analysis with context to where the general market is going?
That is the best question. Give that man a Pabst Blue Ribbon, which you may not know in that analogy. Because of time, I started eliminating some slides for this presentation. That was the last slide that I eliminated from this presentation. So thank you for ever answered that. How is the markets evolved? I think one of the ways, or 2 ways, is one, momentum trading is much bigger now than it ever has been because so many moms and pops are involved in this and everybody thinks they're an expert and people just get on these trends and ride them to ever. The other one, I agree with you, is relative strength, right? Relative strength. There are so many index hugging products out there, index, mutual fund, ETFs, which are based off of index. Some would say big managers or portfolio managers who are so afraid to underperform the market that they're more focused on not underperforming to hold their jobs as to overperforming, right? And so when we see this, boy, for an issue to break the opposite way, we'll say in issues in the S&P 500, and the whole market's going up, and this one issue is going back the other way, that's not only going back the other way, it's also countering all that positive momentum in buying that's been happening just because it happens to be part of the index. That is a major, major component that I certainly look at.
So I guess part of it is looking at what's the natural passive flow you would expect to happen with the security, and then what are the actual traders or individual investors who aren't linked to the index? How do their volumes matter with the context of the price movement?
Yeah, that's exactly right. And it's something that when I write volume indicators, it's the same thing. Oh, this is a big volume day. Well, you need to look at the whole index and then take that into account and subtract that out to really see, was it a big volume day or was it just a big volume day in comparison? Because it was pulled along because the total index was. So absolutely, you're looking for divergences, which also wasn't in this, or convergences. These things give us clues.
Yeah. Well, Ray, we'll have to get you back for another webinar at some point to cover some of these extra indicators. Got a couple of housekeeping items I need to announce to the audience. So thanks everyone for attending another CFA Society Ottawa webinar. I'd like to bring some attention to our upcoming events and webinars. So everyone, we've got our annual lifestyle event on February 10th. And this event is free for our members and only $10 for our non-members. And that actually includes a free Uber Eats credit as well. So you're basically paid to attend this one. So highly recommend that you all attend the event and recommend it to your friends and colleagues at your respective organizations. Next, we have another online education session on the case for structural evolution in private equity. And that's another Zoom webinar on February 16th. And I hope to see you guys at these upcoming webinars. And thanks again for attending. And thank you very much, Ray, for the wonderful presentation.
Thank you so much, and hope to see you in Canada someday.
Yeah, well.